how governments fight inflation. In October 2021, inflation in the US hit 6.2%, the highest it had been in almost 40 years. Since then, it has only gone up. The US annual inflation rate was over 8.5% in March 2022. And global inflation is pushing past 6% too. What do these numbers mean for us? In this quick read, we'll explore the causes and consequences of inflation and the policies all developed nations use to stabilize the economy. Consider this: the same loaf of bread that cost 10 pence in 1970 would be priced around 110 pence today. This is the work of inflation, defined as the decline in purchasing power of a currency over time. Inflation can occur slowly over decades or extremely fast. In November 2008, Zimbabwe experienced hyperinflation, with prices nearly doubling every 24 hours. Now, some inflation is considered acceptable, even advantageous for economic growth. This is what the US is seeing in 2022, with goods like meat, poultry, fish, and eggs priced 13% higher than in the previous year. Several factors can contribute to an overheated economy. The demand pull theory of Keynesian economics points to excess money in circulation as a main culprit. The US saw this in 2020 with the issuance of COVID-19 relief funds. Supply chain disruptions can also exacerbate a hot economy. Restrictions on oil imports following Russia's invasion of Ukraine created supply shortages on the global oil market, causing gas prices to soar. And fears of rising inflation can create a self-fulfilling prophecy, as sellers increase prices to protect their profits. When inflation begins to spiral out of control, what are our options? A nation's central bank can draw upon a number of actions, enacting monetary policy, to recalibrate the economy. One of these is an interest rate hike on banks. Here's how it works: banks are typically required to have a minimum reserve of cash on hand at all times. When the economy is hot, customers make more withdrawals, which eats into this cash reserve. And if a bank's reserve gets pushed too low, it's forced to take out loans from other banks at an interest rate set by a nation's central bank. Raising this interest rate encourages banks to limit the number of loans they approve, reducing the amount of money in circulation. What's more, to avoid losing revenue, commercial banks will charge higher interest on the loans they do give to consumers and businesses. Loans become more expensive. This reduces spending money across the board. Consumer demand for goods and services will drop. And lower prices should follow. The ultimate goal of monetary policy is to achieve stable prices again by encouraging saving over spending. But this proven approach comes with other risks. Even rumors of interest rate hikes can cause the stock market to tumble, as investors exchange stocks for more stable investments like bonds. And if interest rates rise too quickly, the economy may grind to a halt and fall into a recession. One way to curb prices while avoiding an economic downturn is the soft landing, a series of smaller interest rate hikes that slow economic activity gradually. This approach takes time and asks consumers to spend carefully, which can be difficult. But each dollar that individuals, banks, and businesses can pull from the economy pushes a nation's inflation rate closer to normality. The main ideas. During periods of high inflation, central banks enact monetary policy to reduce the amount of money in circulation and recalibrate the economy. The soft landing, a series of minor interest rate hikes, is more likely to stabilize prices without creating an economic depression. The purpose of monetary policy is to encourage saving over spending.